Welcome to Tech Money Madness, your daily U.S. stock market podcast. July 2026.
Glad to be here. Looking forward to diving in.
Yeah, so today is just, well, it's one of those days where the top-line numbers are totally lying to you.
Oh, completely.
Because you glance at the market overview, and it feels like, standard tech euphoria in some corners. But then you look closer, and man, the company's actually building the physical parts for this AI boom. They are just suffocating right now.
Yeah, they're under incredible pressure.
Right. So our mission for this deep dive into the sources is to really cut through all those red and green arrows for you, the listener. We want to help you understand this massive tug of war that's going on between like AI ambition, corporate strategy, and just real-world global tensions.
Because if you just look at the Dow Jones today, you'd think nothing happened. I mean, it barely moved, finished totally flat.
Yeah, totally flat. But underneath that,
there's a massive tectonic shift. The S&P 500 and the Nasdaq both ended lower today. And it was heavily dragged down by this sudden panic over AI's impact on chipmakers.
yeah, we really saw capital just rotating aggressively today. So let's jump right into that first major story. To understand why the S&P and Nasdaq fell, we have to look directly at the heavy hitters, right?
Yeah.
The chip makers.
Exactly.
And the immediate catalyst here was Samsung Electronics. They dropped their earnings report today, and they missed expectations, just flat out missed them.
And the market did not like that at all.
No, the response was brutal. It triggered an immediate 5% sell-off across basically all the broad chip stocks. But I gotta say, okay, let's unpack this, because it feels like we're in a gold rush.
Right, the classic analogy.
Yeah, but the people selling the shovels just reported a bad quarter. I mean, if AI demand is supposedly so high, why are chip makers suddenly struggling so much?
Well, it's the ultimate double-edged sword, really. People assume high demand just automatically equals high margins and easy money.
Right, like they're just printing cash.
But our sources highlight a massive physical bottleneck. It all comes down to these tiny components called MLCCs.
Okay, wait, MLCCs, what exactly are those?
Yeah, so it stands for multi-layer ceramic capacitors. And AI is driving this incredibly intense demand for the absolute highest-end versions of these.
Like beyond what's in a regular computer.
Oh, way beyond. Because an AI GPU draws these huge, violent spikes of electricity. It runs super hot. So these LCCs, they act like microscopic shock absorbers for the voltage.
Wow.
If you put a standard MLCC in an AI server, it just fries. And it takes a $30,000 chip with it.
Yikes. So Samsung and these other manufacturers are forced to make the high-end ones.
Exactly. They have to dedicate their very best, highest yield fabrication lines exclusively to this AI demand. But there's only so much factory space, you know?
Right. It's a zero-sum game.
So by hyper-focusing on AI, they're actually creating component shortages in their other markets, like consumer electronics and especially the automotive market.
I mean, that explains the earnings miss then. They're literally starving their own legacy businesses just to feed the AI beast.
Yep, they're cannibalizing themselves.
But amid all that, amid that 5% sector-wide drop, there was this glaring anomaly today.
Oh, yeah.
What's fascinating here is NVDA. I mean, despite the rest of the sector bleeding out, NVDA actually fought its way into the green today.
Yeah, they totally defied macroeconomic gravity today.
It was one of the most active stocks of the day, right up there with Apple and Tesla. Traders are clearly betting on a massive NVIDIA rally. It just shows how wild the volatility is in this sector right now.
Well, institutional traders are just dumping the messy, horizontally integrated companies. If you have exposure to slow consumer markets or, these fabrication bottlenecks, they're out.
They just want the pure play winners.
Exactly. NVIDIA isn't building the messy physical capacitors. They're just designing the architecture. So the market pays a premium for that.
Right. You want to avoid the messy physical world. But as we see in the sources today, you just can't avoid the physical world forever. Especially with what you mentioned about the automotive shortages.
Geopolitics is actively rewriting the playbook right now.
Yeah, we really need to pivot to that. The physical real-world supply chains are under major attack today. And I'm going to run through a quick rapid-fire list of these geopolitical developments from the sources.
It's a heavy list today.
It is. And real quick, just to be totally clear to you listening, we are strictly reporting the facts from the source material here. We are not taking sides or endorsing any political viewpoints, just looking at how this impacts the market.
Right, just market variables.
Exactly. So first, the U.S. has officially revoked Iran's oil sales authorization following those recent tanker attacks.
Which is huge for energy pricing models.
Massive.
Yeah.
Second, the U.S. Department of Defense just designated a major Chinese LiDAR maker as a national security threat. And third, Donald Trump has arrived in Turkey at a time when NATO is really being strained by Russian attacks and just general U.S. impatience.
It's just shockwave after shockwave for corporate boards.
It really is. And here's where it gets really interesting. These global tensions are literally forcing companies to rethink their physical locations.
Yeah, they have to.
Look at Toyota. Massive announcement today. They're making a $3.6 billion investment to physically move production of the Tacoma pickup truck out of Mexico and directly into Texas.
If we connect this to the bigger picture, you're seeing a fundamental rewiring of the global economy.
Explain that a bit more, because $3.6 billion is a huge upfront cost just to move a factory.
It is, but for the last 30 years, the whole goal was global efficiency, right? Find the cheapest labor, ship it just in time, maximize your margin.
Right, the classic globalization model.
But now, between volatile energy prices, unpredictable tariffs, and things like the DoD blacklisting your cheapest LiDAR supplier, efficiency is dead.
Wow, yeah. The DoD says you can't use that Chinese laser sensor for your autonomous cars anymore. You have to completely redesign your hardware.
Exactly. You have to find a domestic supplier, which costs way more. So Toyota is essentially calculating that spending $3.6 billion today for regional security is actually cheaper long-term than dealing with a fractured global supply chain.
They're building a fortress.
A very expensive fortress.
And that brings up the next major theme from today's sources. Because if you're building fortresses and redesigning LiDAR and competing for ultra-expensive AI chips, how on earth are you paying for all this?
That is the trillion-dollar question right now.
Capital has essentially become a strategic weapon.
This raises an important question. Are we seeing a permanent market divide between companies that can effortlessly self-fund AI and those struggling for basic capital?
It really looks like it. Just look at the contrast in the sources today. Amazon just went to the bond market and raised a staggering $25 billion.
And they noted they won't even issue any more debt for the rest of 2026.
Right. They just held out their hand, and institutional investors happily gave them the GDP of a small country.
Because Amazon's cash flow is so predictable, the risk is perceived as near zero.
But then you contrast that with Rivian. Rivian's stock plummeted 18% today. 18%, and simply because they had to sell 75 million shares just to raise the capital to survive.
It's brutal. They can't issue $25 billion in cheap bonds. The debt market won't touch them at a good rate.
So they have to dilute their own shareholders.
Yep. They print more shares, the value drops, and the market punishes them instantly.
The big tech companies are spending so aggressively on AI evolution right now, it's like they're operating as their own nation states.
They really are. Like Meta today.
Oh yeah, Meta announcing Muse Image. This is their very first native AI model for image creation.
Aimed directly at keeping creators and advertisers inside their walled garden.
Right, because if they don't have it, advertisers will just take their money elsewhere. But building Muse Image requires those exact same AI chips and MLCCs that are causing the global shortage.
Which is incredibly expensive. Look at Microsoft.
Yeah, Microsoft stock actually fell 1.4% today. And that was right after they announced widespread job cuts.
It just shows the human cost, right?
Yeah.
Even Microsoft has to trim its workforce to balance the books on this massive hardware expenditure.
That's wild. Let's do a quick roundup of the other notable market movers today so the listener has the full picture.
Let's do it.
On the winner's side, AMD jumped a massive 8% today on autonomous driving adoption news.
Which ties perfectly back to that DoD blacklist of the Chinese LiDAR. When the cheap foreign hardware is banned, domestic alternatives like AMD become the default.
Exactly. Broadcom, ticker AVGO, they rose 4.4% today. They just extended their massive chip supply deal with Apple.
The market loves certainty.
It really does. But the biggest jaw-dropper was Tesla. Tesla surged 5.8% today. They added a staggering $91 billion in market value in a single day.
Just unbelievable momentum there.
And on the flip side, the losers. Honeywell, ticker HON, they tanked 7.2% post-spinoff, and Amgen, MGN, they fell 2.6%.
The market is offering zero grace period for messy restructurings right now.
None at all. So what does this all mean?
Yeah.
How should a listener parse a day where Tesla magically adds $91 billion in value, while Rivian falls 18%, and a legacy giant like Honeywell just tanks?
It means we're in an era of hyper-concentration. But, while these tech giants are battling for chips and billions in capital, we can't forget that These shockwaves eventually hit the ground level.
Right, the everyday economy.
Exactly, and specifically the housing market.
Yes, this is the final thing from our sources today, and I think it's so important. The real estate sector is currently shifting into what they are calling a balanced market.
Which is industry speak for things are finally cooling down.
Right. Why should the listener care about that in the context of everything we just talked about?
Because more and more real estate agents are now reporting price cuts. After years of buyers just absorbing higher prices and crazy rates, they are finally tapping out.
They just don't have the liquidity anymore.
No, they don't. And after all that high-flying tech volatility we just discussed, companies raising $25 billion in an afternoon, this real estate cool down is a huge fundamental shift in everyday market dynamics.
It really offers a sobering counter-narrative to the tech boom, doesn't it?
It does. It shows the consumer is fundamentally exhausted.
Man, it really puts it in perspective. Let's quickly recap the incredible scope of what we dug out of the sources today.
It was a lot of ground to cover.
We started with Samsung's chip struggles and that massive physical bottleneck. We looked at Amazon's massive $25 billion bond sale versus Rivian's dilution.
Then Toyota moving to Texas for $3.6 billion to secure their supply chain.
Right, fleeing global efficiency for regional security. And finally, finishing with this cooling housing market.
It leaves you with a pretty wild thought to mull over.
Let's hear it.
Well, if the real estate market is balancing out and everyday consumers are cooling down, but big tech is borrowing $25 billion at a time to fuel this insatiable AI arms race, what happens when those two completely different economic realities collide?
Wow, yeah. Will tech somehow generate enough innovation to drag the rest of the economy up with it?
Or will a cooling consumer market eventually just starve the tech giants of the ad revenue and hardware sales they actually need to survive?
I mean, somebody has to click the ads and buy the software to pay back those $25 billion bonds, right? It is a mass attention watch.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.